10 beginner investing mistakes I will never make again. When I first stepped into the world of investing, I thought I was smart enough to beat the market. I devoured success stories, chased the hottest stocks, and expected my money to double overnight. But the reality was very different and brutal. I lost sleep over plummeting stocks, watched my portfolio bleed because I put all my eggs in one basket and paid fees and taxes I didn't even know existed. Worst of all, I let fear and greed control my decisions, making mistakes that cost me thousands of dollars. Looking back now, I realize these early mistakes are what separate amateur investors from those who actually build wealth. These painful lessons taught me the truths that no YouTube guru or finance influencer ever explains in detail. It's not about picking the next Tesla or catching the next Bitcoin wave. It's about avoiding the silent traps that quietly drain your wealth while you think you're doing everything right. In this guide, I'll open up about the 10 biggest mistakes I made as a beginner investor, the ones that nearly wrecked my financial future, and how I've learned to never repeat them. Whether you're just starting your investing journey or still battling your own bad habits, this is the brutally honest wake-up call every investor needs to hear. If I could go back in time and avoid these errors, I'd be years and thousands of dollars in ahead by now. Don't make the same mistakes I did. Welcome to WealthEchelon, your go-to spot for smart investing, in-depth ETF insights, and book reviews that help you build wealth. On this channel, we explore everything from the best investment strategies to the latest trends in ETFs, and provide valuable takeaways from books that can transform your financial journey. Whether you're a beginner or an experienced investor, our goal is to give you the knowledge you need to make informed decisions and grow your wealth. If you're ready to elevate your financial game, hit that subscribe button, and don't forget to turn on the bell for updates on all our latest content. When I started my investing journey, I was full of excitement, curiosity, and confidence. I read blogs, watched YouTube videos, and thought I could easily double my money in a few months. But reality hit hard and fast. As I reflect on my early investing mistakes, I realize these painful lessons shaped the smarter investor I've become today. In this article, I'll share the 10 biggest beginner investing mistakes I made and vow never to make again, so you can avoid falling into the same traps. 1. Chasing hot stocks and hype without research. One of the first investing mistakes I made was chasing the next big thing. I remember when a friend told me to buy shares of a tech startup that was getting attention on Reddit. Without doing proper research or understanding the company's fundamentals, I jumped in, only to watch the stock crash by 60% within weeks. It was a hard lesson. Hype fades, but fundamentals last. Now I realize that good investing requires studying a company's financial health, industry position, and growth potential, not chasing short-term trends or social media buzz. Many beginners, like I did, believe they'll catch the next Tesla or Amazon early. But truthfully, those opportunities are rare, and picking individual winners is nearly impossible without deep research. I learned that patience and careful analysis always beat gut instinct and internet excitement. 2. Timing the market instead of time in the market. I used to believe I could time the market, buying low, selling high, and making quick profits. But trying to predict short-term price movements is a fool's game. I'd sell when the market dipped, only to see it rebound the next week. I'd wait for a perfect dip to buy in, but the market would climb without me. These emotional decisions cost me returns. Now I know the truth. Time in the market beats timing the market. Staying invested over years through ups and downs is what builds wealth. Missing just a few of the market's best days can destroy your returns. Instead of timing the market, I've embraced dollar-cost averaging, buying consistently over time, and letting compounding work its magic. 3. Ignoring diversification. Early on, I made the mistake of putting most of my money into one or two stocks I believed in. When they underperformed, so did my whole portfolio. This lack of diversification amplified my risk and led to sleepless nights. I learned the hard way that no matter how confident you are in a single stock, things can go wrong, and you need other investments to balance the risk. Today, I prioritize diversification across industries, sectors, and geographies. Broad market index funds, ETFs, and sector exposure help protect my portfolio from the unexpected. Diversification doesn't guarantee gains, but it smooths out the ride and reduces the chance of catastrophic loss. 4. Overtrading and paying unnecessary fees. In my excitement, I used to trade frequently, buying and selling stocks whenever I saw an opportunity. I thought I was being smart and active, but in reality, I was racking up transaction fees, taxes, and poor trade decisions. Every trade cost me money, and frequent trading meant I was acting on emotion rather than strategy. Over time, I realized that overtrading is dangerous. Most professional fund managers underperform the market precisely because they trade too much. Now, I make fewer moves, think long-term, and avoid unnecessary activity that erodes returns. Sometimes the best move in investing is doing nothing at all. 5. Failing to set clear goals. When I started investing, I had no clear goals. Was I saving for retirement, a house, or a dream vacation? I didn't know. I just wanted more money. Without clear objectives, my investment choices were random and unfocused. I chased returns without considering risk tolerance, time horizon, or purpose. That changed when I finally sat down and defined my goals. I set targets for retirement, emergency funds, and short-term spending. Now I choose investments that match each goal: conservative assets for short-term needs, growth stocks and ETFs for long-term wealth. This clarity has transformed my strategy and reduced stress. 6. Letting emotions drive decisions. Greed and fear. These emotions controlled my early investing decisions. When markets rose, I felt invincible and bought more than I should have. When markets crashed, I panicked and sold at the worst moments. Emotional investing caused me to buy high and sell low, the exact opposite of what I should have done. One of the greatest lessons I've learned is emotional control. Markets will swing wildly, and headlines will scream doom or euphoria. But successful investors stay calm, stick to their plan, and ignore the noise. I no longer check my portfolio every day. I trust my strategy and focus on the long term, not the daily drama. 7. Ignoring fees, expenses, and taxes. At first, I paid little attention to expense ratios, account fees, and taxes. What difference could a 1% annual fee make? Turns out, a huge difference. Over decades, even small fees can slash your returns by tens of thousands of dollars. I also learned the hard way about capital gains taxes. Selling investments too soon triggered big tax bills I wasn't prepared for. Now I'm fee conscious. I prefer low-cost index funds and ETFs with minimal expense ratios. I use tax-advantaged accounts like IRAs and 401ks when possible, and I consider tax implications before selling. Keeping more of your money is just as important as growing it. 8. Following the crowd blindly. I used to believe that if everyone was buying something, I should too. Whether it was meme stocks, crypto coins, or tech IPOs, I followed the crowd into risky territory, often too late. By the time the public piled in, the best gains were gone and losses were looming. Following the herd is dangerous. Markets are forward-looking. By the time news reaches the masses, insiders and smart money have already acted. I've learned to be skeptical of hot tips and viral trends. Now I do my own research, form independent opinions, and resist the urge to join the crowd. 9. Underestimating the power of compounding. When I started investing, I wanted fast results. I thought doubling my money in a year was the goal. I completely underestimated the slow, relentless power of compounding, the real engine of wealth creation. Compounding takes time, but it turns modest returns into massive gains over decades. For example, investing $200 a month at an 8% annual return grows to nearly $600,000 in 40 years. But stop early or start late, and you lose hundreds of thousands. I now realize starting early, staying consistent, and letting compounding work is the smartest and simplest path to wealth. There are no shortcuts. 10. Neglecting an emergency fund. My worst mistake of all, Investing money I couldn't afford to lose. I put everything into stocks without an emergency fund. When unexpected expenses hit, like medical bills and car repairs, I had to sell investments at a loss to cover them. That painful experience taught me, before you invest, you need a safety net. An emergency fund, 3 to 6 months of living expenses in cash, protects your investments. It lets you handle life's surprises without touching your portfolio. Now I keep my emergency fund fully stocked so I can invest with confidence, knowing I won't be forced to sell in a downturn. Lessons that will stay with me forever. Looking back, these 10 mistakes cost me time, money, and peace of mind. But they also gave me priceless lessons that shaped the investor I am today. Investing is not about luck or genius. It's about discipline, patience, and continuous learning. Mistakes are part of the process, but the key is not to repeat them. Now I invest with purpose, not excitement. I focus on low-cost, diversified assets rather than chasing hot stocks. I let time and compounding do their quiet, unstoppable work. I protect my future with an emergency fund and clear financial goals. And most importantly, I control my emotions, sticking to my strategy even when markets swing. For anyone just starting their investing journey, I offer this advice. Avoid these mistakes and you'll save yourself years of frustration and financial pain. Learn from the scars of those who went before you. Invest wisely, think long-term, and let patience guide your path. Wealth is built over decades, not days. And the sooner you embrace that truth, the richer your future will be. Thank you for watching Wealth Echelon. We hope you found valuable insights that will help you on your investing journey. If you enjoyed the video, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss an update. Keep building your wealth, and we'll see you in the next video. Don't forget to check out our other videos for more investing tips, ETF strategies, and book reviews to continue growing your financial knowledge.